Hi there, another video here from FundingStore. Today we're going to have a look at the different options available to businesses for funding, ranging from debt to equity, the different kinds of debt and equity, and where they are most appropriate. So here comes the presentation. There is now a wide range of funding available to SMEs, so much so that it can seem daunting and a minefield to find what you're looking for. FundingStore.com has been created to help SMEs navigate their way through the funding world, providing guidance and then linking you with both the right funders and advisors who can help you raise the money. This video provides an overview of the various funding options that are available. Follow-on videos are also available that will help you assess how much funding you may be able to raise, and also on how the type of funding changes throughout the business life cycle. The Prezi used can be separately downloaded as a reference document as required. Let's start by having a high-level look at the key factors and considerations that impact on the type of funding that is right for a business. Note firstly that different types of funding have different risk and reward characteristics, so the more risk in an investment, the higher return will be demanded by the lenders or investors. Partly linked to risk and return is also the availability of security over assets, which gives some protection to the funder. Security may be granted either over assets in the business or by a personal guarantee provided by the owner. The amount of money needed also drives availability. Although that is not as straightforward as might be thought, it is not the case that less money is easier to raise, as many funders will want to invest minimum levels, which can in some cases be in the millions. And so if requirements are below this, the funding source might not be available. Finally, and most importantly, is the quality of the opportunity. Any funder wants to make the maximum return for the minimum risk, and therefore business opportunities that are scalable, with market leadership and innovation, will inevitably be more attractive and therefore fundable. Overall, the strength of the management team and ability to deliver will also be critical to an assessment of fundability. Moving into the detail, there are three broad types of funding that are available. These are debt, equity and mezzanine. Each of these have a myriad of different structures, many of which can have characteristics of more than one type of funding. Looking first at debt funding. This encompasses any form of borrowings whereby the business is required to pay an interest charge and repay the capital amount borrowed. It is shown as a liability on the balance sheet and generally represents lower risk funding. The lender will often want to take security over the business and possibly personal guarantees from the owners. In addition, certain conditions or covenants will often be required, such as maintaining certain levels of profitability or a level of debtors. These give the lender protections and powers if the conditions are not met, often allowing them to demand early repayment. People often ask us whether debt is just available from banks. Traditionally, it was only banks who provided debt finance, and this is what they were set up to do. However, over recent years, there has been an expansion of other organisations providing debt facilities, both to exploit market opportunities, but also due to increasing resistance from banks to lend money in some situations. Specialised asset lenders have been set up to provide specific forms of debt, and there's also been a recent trend of what is known as peer-to-peer lending, whereby businesses or individuals pool together smaller amounts of funding to lend in aggregate to businesses. In addition to these new sources, there has also been a rise in the so-called challenger banks. Whilst these are banks in the normal sense of the word, they have entered the market over recent years and provide more competition to the traditional high street banks. As the source of debt funding has increased, so have the common types of debt funding. Overdrafts and term debt are the traditional forms of borrowing from banks, which most people will be familiar with. However, overdrafts are now increasingly rare. They do not work for banks from a financial perspective because of the regulation and capital adequacy requirements, and as such are now rarely offered and are being withdrawn when in place. A term debt involves a bank lending a specified amount of money over a specified period of time, generally requiring the capital amount to be repaid over the life of the loan, either monthly or quarterly. Before advancing a straightforward loan, the bank will want to understand what security is available and have confidence in future cash flows for repayment of both the interest and capital amounts. Typical interest rates on term loans will be 3 to 7% over the base rate. An increasingly popular form of bank debt is also known as asset-based lending, also referred to as ABL. This is where specialist lenders have been set up. They will lend amounts of money against nominated assets within the business, hence the name, with the amount lent being a percentage of the value of the related asset. Typically, assets that can be used in this way are property, by way of commercial mortgage, fixed assets by way of asset finance, stocks by way of trade finance, and trade debtors by way of invoice finance. Stock and debtor financing is particularly attractive as there is generally no requirement to repay the capital amounts, and indeed additional funds can be borrowed as the business grows, although the valuation placed by a lender on stock will often be very low. Because the lender will always take security, such funding often incurs relatively low interest rates. Typical interest rates on asset-backed financing is 2.5 to 5 over base rate, and the lenders will advance normally up to 85% of the asset values. That gives an overview of debt funding. Let us now explain a bit more about equity. Broadly, equity involves funds raised by way of issuing shares in the business. This dilutes or reduces the percentage ownership of existing shareholders, typically management, but raises funds that don't have an interest or dividend cost and don't normally have to be repaid. The external investor will take either a minority or majority stake, depending on the level of funds invested and their desire to be involved in the ongoing management of the business. There is no requirement for security, and therefore equity funding is relatively risky and typically used by growing businesses who cannot or do not wish to raise debt. Equity funding can come from either public or private sources. Public equity involves floating the business on a recognised stock exchange, raising money from the public, and specialist institutions who can then openly trade their shareholdings. Given its characteristics, a public flotation is only normally suitable for established businesses. Private equity refers to investment from non-public sources and can be broken down further into venture capital funds and private individuals. Venture capital funds are specialist organisations, often funded by banks, pension funds and insurance companies. They invest in high-growth businesses and look to make an equity return across their portfolio of businesses. Investment from private individuals, often called business angels or high net worths, works in exactly the same way, although amounts are somewhat lower, and can often be invested at the same time as venture capital. We talked earlier about the interest rates payable on debt, so what are the rates of return attaching to private equity? As the investment is by way of shares, with a return from selling those shares, that return is a function of the increase in capital value over the period of the investment, and is therefore not a cost to the business. Venture capitalists will generally look for a return of up to 30% compound, year on year, known as the IRR, or internal rate of return, with business angels typically looking for a doubling of their investment over a 3-year period. And finally, the other form of funding mentioned earlier is mezzanine, which many people have never heard of. So what is it? In essence, mezzanine finance is a hybrid of debt and equity. As such, the investment could be in a combination of borrowings and equity, but also includes more sophisticated instruments such as warrants or options over shares. Mezzanine lending is appropriate where there is some security available, but not enough to cover the total funding requirement. As such, the lender is taking a greater risk than lending debt, but not as much as equity. As would be expected from the nature and risk of the funding, the cost of mezzanine funding lies between that associated with debt and that associated with equity. The overall rate of return will generally be between 12.5% to 20%, and will be a blended rate of the return from the various parts that make up the total funding pot. It is worth having a quick look at the tax situation attaching to equity investments, including the relevant proportion of mezzanine packages. Because equity is normally related to entrepreneurially and growing businesses, there are attractive tax reliefs available. This is the subject of a separate video, but to put it simply, the investor, i.e. a business angel or venture capital fund, can set off a proportion of their investment against their wider tax bill, and they also get reduced rates of capital gains tax when an exit is made. Such tax incentives, e.g. SEIS and EIS, have been very helpful in encouraging this type of investing. although it should be noted that equity investments are, by definition, high risk, and as such should only be considered by experienced investors. We hope that was useful. If you have any questions, give us a call on 01565 756 141 or have a look around fundingstore.com.